Before you do anything else today, I need you to go find the beneficiary designation form for your IRA or your 401k. Not your will, not your trust, the beneficiary form, the one you filled out when you opened the account. Because right now in 2026, that form is the single most powerful legal document in your estate. It overrides your will. It overrides your trust. It overrides anything your attorney wrote. And if it has the wrong name on it, an ex-spouse, a deceased parent, a child you intended to treat differently, the money goes to that person the moment you die, regardless of every other instruction you ever left. I want to start with a story because this one is too important to bury. A woman I will call Helen spent 41 years as a high school English teacher in suburban Michigan. She retired at 63. She had a traditional IRA worth $220,000 that she had built over 3 decades of careful saving. She had 2 adult children, a son named David and a daughter named Karen. She had been divorced for 19 years. Her ex-husband's name was Richard. Helen had a will. She had worked with an estate planning attorney 8 years before she died, and the will was clear. Everything to David and Karen split equally. She had told her children this. She had shown them the will. She had updated the will twice, once after her mother passed and once after she sold a rental property. Helen was organized. Helen was prepared. Helen died in March of 2024. 3 weeks after her death, David and Karen were notified by the IRA custodian that the account had been distributed in full to the primary beneficiary on file. That beneficiary was Richard, their father, Helen's ex-husband of 19 years. Helen had opened the IRA in 1987, 2 years before she and Richard divorced. She had named him as the beneficiary because he was her husband, and that was what you did. She had never updated the form after the divorce. In 22 years of contributing to that account, adding to it, rolling over other accounts into it, watching it grow, she had never looked at the beneficiary designation again. Her will said the IRA went to her children. Her beneficiary form said it went to Richard. Under federal law, the beneficiary form wins. Not the will, not the trust, not the letter she left with her personal papers. The form. David and Karen contested the distribution. They hired an attorney. The case was settled more than a year later. Richard kept most of the money, $220,000, gone to a man Helen had not spoken to in nearly 2 decades, because of a form she filled out in 1987 and never looked at again. I'm not telling you this story to frighten you. I am telling you this story because it is not unusual. It is one of the most common outcomes in estate administration, replicated in thousands of families every year, and almost nobody who is currently sitting on a meaningful IRA or 401k balance has verified their beneficiary designation in the last 5 years. My name is Marcus Steele. I am an enrolled agent licensed by the federal government to represent taxpayers directly in front of the Internal Revenue Service. I work with retirees on tax planning, retirement income, and the kinds of estate decisions that produce permanent consequences for the people left behind. And the single most preventable financial disaster I encounter in this work is not a bad investment, not a tax mistake, not a scam. It is a beneficiary form that was never updated. Let me explain exactly why the beneficiary form has the power it has, because most people have never had this explained to them clearly, and understanding it changes how seriously you take the next 20 minutes. When you open an IRA, a 401k, a life insurance policy, or certain bank accounts, you fill out a form designating who receives the account when you die. That designation is a legal contract between you and the financial institution. It exists outside of your will and outside of your trust. It is governed by federal law, specifically the Employee Retirement Income Security Act for employer-sponsored plans like 401ks, and by state contract law for IRAs and life insurance policies. Your will is a document that controls your probate estate. The probate estate is the collection of assets that do not have a designated beneficiary, a joint owner, or a trust designation. An IRA with a named beneficiary is not part of your probate estate. It transfers directly to the named beneficiary upon your death, bypassing probate entirely. That is generally a good thing because probate is slow, expensive, and public. The problem arises when the named beneficiary is not who you currently want to receive the money. The Supreme Court addressed this directly in a case called Egelhoff versus Egelhoff in 2001. A man died with his ex-wife named as the beneficiary of his employer retirement plan. The state of Washington had a law that automatically revoked beneficiary designations in favor of a former spouse upon divorce. The Supreme Court ruled that ERISA preempts state law in this context. The federal law governing employer retirement plans is supreme. The last named beneficiary, regardless of divorce, regardless of a state law attempting to override the designation, regardless of what the will says, is who receives the money. That ruling still stands, and it catches people every year. The Egelhoff case involved an employer plan, but the broader lesson applies across every type of account with a beneficiary designation. The form controls. The will does not. If there is a conflict between what the form says and what the will says, the form wins for every asset that has one. Now let me tell you what the most common errors look like, because the ex-spouse situation is the most dramatic but not the most frequent. The most frequent error is the outdated primary beneficiary, a parent who has been dead for 15 years, an ex-spouse from a marriage that ended decades ago, a sibling who predeceased you. These designations were made at a point in life when the relationship existed and the person was alive. They were never updated. And when the account owner dies, the distribution goes to a person who was never supposed to receive it, or to the account owner's estate, because the primary beneficiary is deceased and no contingent beneficiary was named. That last scenario, the account defaulting to the estate because the primary beneficiary is dead and no contingent is listed, is the second most common error, and it produces consequences that are particularly damaging for the people left behind. When an IRA defaults to the estate instead of a named individual, it must go through probate. Probate is the court-supervised process of validating a will and distributing assets. It is slow, it is public, and it costs money. Attorney fees, court fees, executor fees. Depending on the state and the complexity of the estate, probate costs can consume between 3 and 7% of the estate's total value. On an IRA worth $200,000, that is $6,000 to $14,000 in fees before a single dollar reaches the person it was intended for. But the probate cost is not the worst part. The worst part is what happens to the tax treatment of the inherited IRA when it goes through the estate rather than directly to a named individual. Under the Secure Act and its successor provisions, most non-spouse beneficiaries who inherit an IRA from someone who had already begun taking required minimum distributions are required to take annual distributions from the inherited account and empty it completely within 10 years. That rule applies when the IRA transfers directly to a named individual. When the IRA goes through the estate instead, the distribution rules change, and in some cases, the entire balance must be distributed within 5 years. On a large IRA, the difference between a 10-year distribution window and a 5-year window can be tens of thousands of dollars in additional income tax for the heirs because they are forced to recognize the income faster. A proper beneficiary designation protects your heirs twice. It avoids probate, and it preserves the maximum tax deferral period allowed by law. The third error is the missing contingent beneficiary. Most people, if they update their beneficiary at all, name a primary beneficiary. Many of them never fill in the contingent beneficiary line. The contingent beneficiary is who receives the account if the primary beneficiary predeceases you or disclaims the inheritance. Without a contingent beneficiary, if your primary beneficiary dies before you do and you have not updated the form, the account defaults to the estate. Same probate problem. Same tax acceleration. Same outcome that could have been prevented by filling in one additional line on a form that was already in front of you. The fourth error is naming a minor child directly as the beneficiary. A minor cannot legally own an inherited IRA. If a minor is named as the direct beneficiary of an IRA, the court must appoint a guardian to manage the account on the minor's behalf. That process requires court approval, ongoing court oversight, and in some cases requires the funds to be held in a restricted account until the child reaches the age of majority. The intended gift becomes a legal proceeding. The solution is to name a trust as the beneficiary with the minor as the trust's beneficiary, structured in a way that allows the trustee to manage the distributions on the child's behalf without court intervention. The fifth error is the one that is generating the most new cases in 2026. It is naming no beneficiary at all on accounts opened through newer online platforms and robo-advisors, where the beneficiary designation step was either skipped during account setup or was buried in an onboarding flow that the account holder did not complete. The average defined contribution plan balance across all age groups reached a record $167,970 in 2025. Millions of those accounts were opened through platforms where the beneficiary designation was an optional step during setup. Optional means many people skipped it, and a large account with no named beneficiary is a large account that will go through probate and be distributed according to the account owner's will, or, if no will exists, according to state intestacy laws that may produce a distribution the account owner would never have chosen. Now I want to tell you what to do. Not eventually. This week. The first thing is to log into every retirement account you own and find the current beneficiary designation, not the one you remember filling out, the one that is actually on file. Log in, navigate to the account settings or the beneficiary section, and look at the names. Confirm they are who you intend. Confirm they are still living. Confirm there is a contingent beneficiary in addition to the primary. For 401k accounts from current or former employers, you may need to contact the plan administrator directly rather than logging into a consumer-facing account. Former employer 401k plans in particular are accounts people tend to open and never revisit. A 401k from a job you left 15 years ago still has a beneficiary designation on file. That designation reflects who you wanted to receive the money 15 years ago. If your life has changed since then, the form has not. The second thing is to update any designation that does not reflect your current intentions. The update process is straightforward at most institutions. It is typically a form on the institution's website that takes 10 to 15 minutes to complete. You provide the name, social security number, date of birth, and relationship for each beneficiary. You specify the percentage each receives. You save the form. Done. If your situation is more complex, if you want to leave money to minor children, if you want to leave different amounts to different beneficiaries for specific reasons, if you want to include a trust as a beneficiary for asset protection purposes, working with an estate planning attorney to structure the designations correctly is worth the time and cost. A properly structured beneficiary designation for a large IRA is worth more than 1,000 times what it costs to set up. The third thing is to do this review on a calendar, not once. Once every 3 years, and immediately after any major life event, a marriage, a divorce, a death in the family, the birth of a grandchild, the sale of an asset that changes what you have. Any event that changes your intentions should prompt an immediate review of every beneficiary designation across every account. The most important step up in basis consideration I want to leave you with is this. When you die, your heirs inherit your assets at the fair market value on the date of your death, not at the price you originally paid. That step up in basis eliminates all of the capital gains that accumulated during your lifetime for your heirs. A properly structured estate with proper beneficiary designations allows your heirs to receive that step up. Improper designations that force assets through probate or into the wrong hands do not change the tax treatment, but they change who receives the benefit of it. Your will takes care of the assets that do not have beneficiary designations. Your beneficiary forms take care of the assets that do. Both need to be current, both need to be reviewed. And the beneficiary forms need to be reviewed first because they are the ones that operate outside the will without any court oversight and without any ability to correct them after you are gone. Helen's children spent more than a year in legal proceedings trying to recover what their mother intended for them. They recovered a portion of it. The legal fees consumed a significant share of what they recovered. Richard, a man Helen had divorced 19 years before her death, received more than $200,000 because of a form she filled out in 1987. The form is 15 minutes. The update is free. The consequence of not doing it is exactly what happened to Helen's family. Before I close, I want to give you something you can use immediately. I put together a free checklist, my 2026 Estate Protection Checklist. It covers the beneficiary review process for every account type, including IRAs, 401ks, life insurance policies, and transfer on death bank accounts. It walks through the contingent beneficiary setup, the minor child beneficiary trust option, the inherited IRA distribution rules under the 10-year rule, the step-up in basis explanation, and how proper titling preserves it for your heirs, and the 3 major life events that should always trigger an immediate beneficiary review. Every item includes the specific form or account section to check and the action to take. To get it, go to marcusgravestacks.com/checklist. It is in the description as well. Here's the one thing I want you to do before this video ends. Not after dinner, not this weekend. Before this video ends, open your phone or your laptop, go to the website for your largest retirement account, and look at the beneficiary designation on file. Just look at it. Confirm the name is who you intend and that the person is still living. If it is correct, you just spent 3 minutes and bought yourself peace of mind. If it is not correct, you just found the most important financial problem you have right now. Helen never looked. That is the only thing she did wrong. She built $220,000. She wrote a will. She told her children what she wanted. She just never looked at the form. Send this to one person in your life who has an IRA or a 401k and has not looked at their beneficiary designation recently. That is most people over 50. One share might be the thing that keeps their family out of the exact situation Helen's family spent 14 months trying to escape. I will see you in the next one.